Hey guys, Chris from Adaptation here, and in this video I am going to show you the solution for question 4 from the Jan 2011 PoA Paper 2. If you want to see the solutions for the other questions on this paper, I'm going to put a card up there and a link in the description below, so be sure to check those out as well. And with that said, let's get into the question. Alrighty, so they're telling us that Mr. Best prepared the following information in order to produce the end of year figures for his final accounts being income statement and balance sheet. So we have some sales ledger balances, opening balances, debit and credit, 25 to 60, 540. Okay. We have some purchases ledger balances, Jan 1st, 2020, that's the opening start of the year balances, debit and credit, 350, 32, and 30 respectively. Right. Now we have a whole set of other information, and the interesting part down here is that at the end of the year, we have some missing balances for the sales ledger and for the, a missing balance for the sales ledger, the closing debit balance, and the closing credit balance for the purchases ledger. So, of course, part A wants us to do, guess what? Prepare the sales ledger control account and the purchases ledger control account for Mr. Best for the year ended December 31st, 2010, 15 marks. Okay, so let's start with that sales ledger control account. So, of course, we're going to plug in those first opening balances. We're going to plug in those opening balances first. The debit balance will go on the debit side. The credit balance will go on the credit side, as you can see right here. 25,206 on the debit side, 540 on the credit side. Okay, the next item up I'm seeing, so we have total receipts from customers. Oops, I highlighted something else by mistake, but receipts from customers, 392,600. So that's the amount of money we are getting from our credit customers. Okay, now I know some of the slightly more sharper eyed of you might say, well, it didn't say credit customers, it just said total receipts. So you might have cash sales inside of there. The rest of the question said nothing about cash sales, so we can safely assume this is money coming in from our credit customers only, right? So this is going to go on the credit side of the control account. Why? Because when our customers pay us back, when our debtors repay us, it decreases the amount of money they owe us. Debtors is an asset. If we are decreasing an asset, we have to credit the asset account. Next, let's take a look. We also have sales on credit, 412,500. Now that's going to go on the debit side. Why on the debit side? Because when we make credit sales to our customers, we are selling them goods on credit. Duh. But what's happening is that they now owe us more money than they did before, which means the asset of debtor is going up. And to record an increase in an asset, you have to debit the asset account. Okay, what's the next item across here? So I'm seeing discount allowed, 3,220. So when we allow discount, we are literally reducing the amount of money our debtors have to pay us. We're telling them, don't worry, don't pay us the full amount. We'll accept a lower amount. So we are the ones reducing it. And to reduce an asset, like I said before, you have to credit the asset account. Next, I'm seeing returns inwards, 2,100. So of course, if our customers return goods to us that they previously bought on credit, they no longer have to pay for those goods, especially if something was wrong with them. So that's going to reduce or decrease the asset, which of course is going to be recorded on the credit side of the account. Next, we have bad debts written off, 2,800. Now, when we write off bad debts, we are saying we can no longer reasonably expect to collect this money. So therefore, we are saying these people no longer owe us this money. We are cancelling or reducing the debt. So that's going to go, of course, on the credit side. And the other item I'm seeing here is the set-off item, right? So balance in the sales ledger set off against balances in the purchase of 500. So that's going to go on the credit side, right? A set-off is a cancellation of common debt. Let's say I owe you $10 and you owe me $8. So instead of me paying you 10 and you paying me 8, I'll just give you $2, right? So why does that work? Because we technically both owed each other $8. I just owed you 2 extra. So if we both owe each other $8, we could cancel that debt, not so? That's what a set-off is. It's a cancellation of common debt. Okay, now the other thing to go inside of the control account is the closing credit balance. So of course, the closing credit balance will be brought down on the credit side. But to be brought down on the credit side, it first has to be carried down from the debit side. Yeah, there you go. Right. Okay, so what we have to do is find the closing debit balance. It's going to be brought down on the debit side. But before you can be brought down on the debit side, you have to be carried down from the credit side. How do we find that? We add up all the items on the credit side, add up all the items on the debit side, and subtract. Clearly, the debit side has more. So what's going to happen? We are going to have a balance carried down there of 36,270. And when we total up both columns, both the debit and the credit column, we're going to get the same amount of money. Sorry, the same total on both sides, 438,120. And don't forget to bring down your balance of 36,270. Okay, with the sales ledger control account done, let's take a look at the purchases ledger control account. So we're going to go back to the top and start to populate this account as well. So we have two opening balances. On the debit side, 350, credit side, 32,130. So we're going to put those in, right? 32,130, 350. The next item we are seeing is total payments to suppliers, 308,160. Now, when we pay back our liability, we are reducing the liability. So that's going to go on the debit side, right? So if we pay our suppliers, people to whom we owe money, it means we now owe them less money. We've paid back some of the money we've owed them. What we have just done there is decrease the liability. And to record a decrease in a liability, you have to debit the liability account. Next item I'm seeing is purchases on credit, 321,100. So when we buy more goods on credit, we are now increasing the liability, and that's going to be recorded on the credit side of the liability account because credits increase liabilities. Next, I'm seeing discount received, 4,660. So when we receive discount, that's when our suppliers are literally reducing our liability. That's going to go on the debit side of the liability account. Similarly, returns outwards will go on the debit side because when we send back goods that we previously bought on credit, we no longer have to pay for those goods, especially if something was wrong with them. So therefore, we are reducing our liability, which will of course be recorded on the debit side of the liability account. Right, so we could go to the set-off, right? Don't forget your set-off. That goes in both accounts. Remember, it's a cancellation of common debt. Both accounts have to have it. So we are going to put that on the debit side of the control account, the creditors control account, because that's how you reduce a liability with a debit to the account. Okay, so now we have the the one closing balance we have, right? That's going to be brought down on the debit side. So of course, like I said, if to be brought down on the debit side, you initially have to be carried down from the credit side. So carried down from here, brought down here. Now we're missing the closing credit balance. So the closing credit balance will be here. But to be brought down on the credit side, you have to first be carried down from the debit side. How do we find that balance? Just like above, we add up the figures on the debit side, we add up the figures on the credit side, and we subtract. That's going to give us the figure to go here, which by the way is 38,290. Now when you add up both the debit and credit columns separately, of course, you get the same totals, 353,460 on both sides. And don't forget to bring down your credit balance of 38,290 on the credit side. Okay, we have a part B. Let's take a look at that. Okay, so this is an errors item on suspense account to boot. So Mr. Best extracted a trial balance on July 31st, 2010, which failed to agree by 7,425, a shortage on the debit side of the trial balance. A suspense account was opened up for the difference. Before we go any further, if you know that you have trouble with errors or suspense accounts specifically, I'm going to put a card up there in the corner and a link in the description with my errors playlist. On that playlist, you will find a suspense account video, but I strongly suggest you go through the whole playlist because everything kind of builds towards using the suspense account. The suspense account is kind of like the final product of the errors correction procedure, at least in a CSEC POA context. So again, if you know you're not too strong with suspense accounts and errors as a whole, I strongly suggest you go to those videos first and then come back here, because what I'm going to do may not make a whole lot of sense if you're not too comfortable with it. If, however, you feel comfortable and confident enough to proceed with the question, you feel your understanding of suspense accounts and error corrections using suspense accounts is sufficient, let's proceed. Okay. Now, it says in August 2010, the following errors were discovered. So the first error is a sales day book. Hold on, before I read through all four errors, let's just take a look at what they want us to do. It says, write up the suspense account showing the correction of the errors. That's for 5 marks. Okay, so the first thing we're going to do is we're going to put the suspense account balance on the debit side. So that says difference as per trial balance, right? So why is it on the debit side? Because the question said that there was a shortage on the debit side. Okay, back to the first error. So the sales day book had been undercast by 4,100. If something is undercast, that means the balance is too low. If it's too low, that means to fix it, we have to increase it. Now, the sales day book records only credit sales, but that total is transferred to the sales account. So it means we didn't transfer enough. We transferred a figure that was too low to the sales account. So the sales account is undercast or too low. To fix that, we have to increase the balance. To increase the sales account, what is it? How do we classify it? It's a revenue account. To increase a revenue account, you have to credit the revenue account. But every credit needs a corresponding what? Corresponding debit. What account are we going to debit if we just have an addition error or an omission on one side? That's where the suspense account comes in. So we are going to debit the suspense account for that 4,100 figure, right? So you're seeing sales here. Now, an issue a lot of people have is they see the word sales on the debit side of this account and say, but sir, that's a debit to sales. No, it is not. This entry here is on the debit side of the suspense account, right? Of this item here. This is the debit side of the suspense account. So we're debiting suspense for 4,100. This is the detail that tells us the other account affected by this transaction. So I repeat, this is not a debit to sales. This is a debit to the suspense account, okay? And it says that, this is a debit to the suspense account for 4,100. And it says that sales was the other account affected, which would have been credited because every debit needs a corresponding credit. Okay, let's take a look at the second error. So it says a check paying $3,500 to B. Ashton was entered in the cash book, but not in the personal account, which means B. Ashton's account is missing this entry. So if we paid a check to somebody, we're going to credit the cash book and we're supposed to debit B. Ashton. But it wasn't entered in B. Ashton's account. So B. Ashton is missing a debit. B. Ashton is missing a debit. Okay? So to fix that, we have to debit B. Ashton. But what account are we going to credit? Again, that's where the suspense account comes in. So you're seeing on the credit side here an entry for 35. So this is a credit for 3,500 and it says B. Ashton is the other account affected. Again, this is not a credit to B. Ashton. B. Ashton is on the credit side of the suspense account. This is a credit to suspense. Okay. Next error. We have inventory at close was undervalued or undercast or understated by $3,900. Undervalued means it was too low. What do we do to fix it? We have to increase the balance. Inventory is an asset. How do we increase an asset? By debiting it. And if we have to debit inventory, we need a credit. What account are we going to credit? That's where the suspense account comes in. So we are going to credit the suspense account for $3,900 and say that stock is the other account affected. Again, this is not a credit to stock. This is a credit to the suspense account, and stock is the details, the other account affected by the transaction. Okay, there's one more error to fix. That was discount received of $4,125 from a supplier was not posted to the supplier's account. Okay, so discount received, as we just saw in the control accounts above, is supposed to go on the debit side of the creditor's account, because that's reducing the liability. If they give us a discount, they are reducing the liability, which is recorded via a debit to the liability account. So to fix that, if it was not posted in the supplier's account, we have to debit the supplier's account. But what account is going to be credited? The suspense account. So we're going to see the credit to the suspense account here. So again, we are crediting suspense for $4,125, and of course, supplier is the detail. Again, this is not a credit to supplier. This is a credit to the suspense account, with the supplier being the details, the other account affected, which of course would have had to have been debited. And when we total both sides, something interesting is going to happen. Both totals are going to be equal without us having to balance off, which means we found all the errors and the suspense account balances, and the trial balance is going to balance too. Okay, that's about it for this question. Okay guys, so there you have it. That's the solution for question 4 from the Jan 2011 POA Paper 2. If you have any questions about it, please feel free to leave them in the comment section below, and I'll get back to you whenever chance. If you want to check out any more videos, I'm going to put some cards up here. Don't forget to subscribe, and be sure to check out my website where you'll find some pretty useful POA handouts. Anyway guys, as per usual, thank you so much for watching. Take care of yourselves, and I'll see you next time. Bye.